As we move towards an increasingly complex global landscape fraught with geopolitical and economic risks, central banks across the globe have been ramping up their efforts to bolster their gold holdings. Notably, China, the world's second-largest economy, has continued its buying spree, with a sixth consecutive month of increased gold reserves. The State Administration of Foreign Exchange in China recently reported that the country added 809 tons of gold reserves in April, bringing its total to a staggering 2,076 tons. While it may seem peculiar that central banks are increasing their gold reserves, it is a trend that has been on the rise for some time. The reason for this shift in investment strategy is twofold: to achieve asset diversification and to safeguard against the potential depreciation of the US dollar and uncontrollable inflation. The World Gold Council's latest data indicates significant growth in central bank gold reserves in the past year. In the first quarter of 2023, global reserves increased by a whopping 228 tons, the highest since the first quarter of 2013, with some developed countries, such as Singapore and Turkey, joining the ranks of gold buyers. This trend is indicative of a growing concern among countries about the risks of over-reliance on the US dollar, which may impact their foreign exchange reserves, resulting in a decline in their valuations and a sharp depreciation of their currencies. Last year's significant interest rate hike by the Federal Reserve caused the US dollar to soar, resulting in a sharp drop in the value of non-US dollar-denominated assets in many countries' foreign exchange reserves. As such, countries are accelerating the diversification of their foreign exchange reserve assets. It is likely that countries will continue to increase their gold holdings, relying on gold's safe haven attributes to hedge against the depreciation of assets due to high inflation and the volatility of financial markets, and to achieve the preservation and appreciation of foreign exchange reserves. With the risk of global financial market volatility still prevalent due to economic recession in Europe and the United States, the pressure on countries to maintain stable foreign exchange reserves will remain high. As central banks increase their gold reserves, the price of gold has risen dramatically, nearly reaching its all-time high. With the ongoing credit tightening and concerns about signs of a slowdown in the U.S. economy, the demand for gold has continued to grow, making it a more attractive safe haven asset. China's recent large-scale purchases of gold, beginning in November 2022, mark its first such action since ending a 10-month buying spree in September 2019. Prior to that, China's last gold buying spree ended in late 2016. Furthermore, as of the end of April, China's foreign exchange reserves have increased to $3.2048 trillion, up $20.9 billion from the end of March. This uptick in reserves is indicative of China's increasing efforts to bolster its financial position and safeguard against potential economic risks. As geopolitical risks continue to mount, it is likely that we will see more countries following China's lead, increasing their gold reserves to ensure the preservation and appreciation of their foreign exchange reserves in the years to come. China's State Administration of Foreign Exchange recently issued a press release highlighting the expansion of its foreign exchange reserves, attributing it to a combination of exchange rate conversion and changes in asset prices. The release emphasized China's positive economic outlook, signaling signs of recovery and improvement that contribute to the overall stability of its foreign exchange reserves. In stark contrast, the United States finds itself teetering on the precipice of a financial and economic catastrophe, with the ongoing deadlock over the debt ceiling casting a dark shadow. Treasury Secretary Janet Yellen sounded the alarm on May 4th, warning that failure to increase the debt ceiling would plunge the U.S. into a dire state of financial and economic calamity. Concerns surrounding the U.S. banking industry persist as Silicon Valley Bank, Signature Bank, and First Republic Bank have recently experienced significant collapses, despite Federal Reserve Chair Jerome Powell's insistence on no interest rate cuts this year. Bond investors remain skeptical, betting on an eventual rate cut due to mounting financial stability pressures. As the repercussions of interest rate hikes become increasingly apparent, the recent demise of these three medium-sized banks has led to stricter lending conditions for both households and businesses, amplifying the risk of an impending recession in the U.S. economy. Goldman Sachs estimates that the widespread contraction of bank lending could result in a substantial 0.4 percentage point drop in U.S. economic growth this year, which has the potential to trigger a recession. To compound matters, a daunting $31 trillion in U.S. debt defaults looms large. In January of this year, The U.S. debt had already reached the debt ceiling of $31.4 trillion set by Congress in September 2021, with a crucial deadline to raise the ceiling approaching on June 1st. It is highly probable that the Republican-controlled House of Representatives will reject the Biden administration's request to increase the debt ceiling, thereby impeding the Treasury Department from issuing additional government bonds and potentially leading to a default on U.S. debt. The consequences of such an event would be catastrophic. Once the U.S. Congress blocks the increase of the debt ceiling, the nation's economy would plunge into an extremely dark state, characterized by a precipitous drop of up to 45% in the stock market, or even a complete collapse. An unprecedented economic recession would become increasingly difficult to evade, while unemployment rates would skyrocket. Economists even warn of a global financial catastrophe if the U.S.'s staggering $31.4 trillion national debt defaults. The debt ceiling quandary poses an overwhelming challenge for the Biden administration. In a bid to avert a debt default, President Biden summoned Republican congressional leaders for discussions on May 9th, but both sides exhibited unwavering stances. Biden made it clear that he would urge Republican congressmen to follow historical precedent and raise the debt ceiling to avoid default, while Republicans maintained a position demanding significant budget cuts, particularly in social welfare and healthcare budgets, as a means of appeasing their voter base. Failure to find common ground will deplete the Biden administration's operating funds at the onset of June, resulting in a government shutdown and leaving the Treasury devoid of any borrowing capacity. Consequently, U.S. government bonds, which serve as the source collateral of the international financial market, would face technical defaults, severely undermining the creditworthiness, safety, and liquidity of these bonds. The repercussions would inflict substantial damage on the hegemony of the U.S. dollar and send catastrophic shockwaves throughout the global financial system. Since assuming office, the U.S., as a global hegemon, has become the root cause behind today's world politics and economics. Factors such as heightened social divisions, opposing national identities, political polarization, irresponsible monetary policies, unsustainable debt levels, and the weaponization of the U.S. dollar have all contributed to this predicament. Express your thoughts by leaving a comment in the section below. We appreciate you for sticking with us until the end of this video. Before you leave, please show your support by giving us a thumbs up and subscribing to our channel. Don't forget to hit the notification bell to stay updated with our latest videos. We look forward to seeing you again for more captivating content in the future.